right now we're seeing a valuation-led meltdown. But while that's happening, analysts continue to raise their numbers. Now, of course, the analysts don't see recessions happening, so that's my job. I don't think we're going to get a recession this year or next year. And so I agree with the analysts about their optimism for earnings.
Let's welcome in Ed Yardeni. He is the president of Yardeni Research. Now, Ed, you got to help me out here because I'm a little confused. Sure. Now, when we talked the other day, and maybe it was late last week, I thought you were making the case of why people were too negative and that why we weren't going to have a recession and why you were more positive than most. And then today I find out that you lower your estimates for earnings, sure, which you said were going to hold up, and then you lowered your target for the S&P 500 to your range to 3825 to 4335 from 42 to 4800. Why?
I'm so sick of these people. You know, oh!
All right. Today is Wednesday, the 25th of May, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight, so let's dive right into it. In focus. Are the bears getting too fat? And before you start bitching and whining in the comment section, what's up with the fat shaming, bro? Rest assured, the bears love to be called fat because fat is sexy in the bear community. But last year, market bulls got sucked in the so-called Santa rally. And by now, we all know that the so-called Santa rally was nothing but an epic bull trap because the bears have been hiding in the bushes, planning and staging a massive attack. And since then, the bears have been eating a lot of bulls. The question is, are they getting too fat now? Are they running out of appetite? And by doing so, paving the way for the bulls to make a comeback into the stock market? Of course, to get slaughtered again when the next season arrives, when the bears become hungry again. Is this what we're seeing right now? Perhaps. But a few things have to happen before the bulls dip their toes back in the water. Some of these things are technical in nature, but some are fundamental in nature, specifically when it concerns the Fed. Market bulls are waiting for the Fed to make a U-turn, for Jerome Powell to channel his inner 2019 Jerome Powell and say, you know what, folks, the stock market went down enough. The oligarchs are mad at me right now. So you know what? We're not going to tighten anymore. Forget about Jerome Powell the hawk. Here comes Jerome Powell the dove once again. And Wall Street is starting to believe this hypothesis. Matter of fact, Wall Street thinks that the only thing that will save the stock market is a Fed pause, quote unquote. But three things would need to happen first for the central bank to stop tightening, like gaining more weight, for example. That'll stop them from tightening their belts, right? And again, I don't need to read this or to know what these three things are because number one, the stock market goes down. Number two, the stock market stays down. Number three, the oligarchs over at Davos, they pick up the phone and say, hey, Mr. Powell, what the hell is wrong with you? Do you want to keep your job? Do you want to stay alive? Then do something, damn it. Pump that stock market higher again. And what do you know? Ta-da! Here it is. Davos elite fear Volcker moment as central banks draw their swords. And I assure you, Jerome Powell is no Volcker. To begin with, Jerome Powell is not even qualified to be a dog catcher, let alone being compared to legendary Paul Volcker. But here it is. The crowd at Davos is now saying perhaps the Fed is getting too harsh. Perhaps the Fed is tightening too much. Perhaps the Fed needs to go back and restart the printing machine once again. Print, baby, print. And of course, we all heard the commentary yesterday from Atlanta Fed President Boystick, who suggested that the Fed pause interest rate hikes by September. So, okay, we'll do 50 basis points in the next meeting, perhaps another 50 in the meeting after that, but by September, we're done, because God forbid the stock market goes down. Whether inflation goes away or not, who gives a shit? Inflation doesn't impact us. It impacts the bums, the peasants, the poor, the middle class, and who cares about these parasites anyways? And now Mr. Boystick comes out and says, or calls for, caution. He says even fire trucks with sirens blaring slow down at intersections. And I say, where was that thinking, Mr. Boystick, when the Fed was printing like crazy? How come the Fed did not take a pause and stop and say, you know what? Are we overdoing it here? Maybe we're going to induce inflation if we keep printing like crazy to prop up the equities and real estate markets so the oligarchs can be happy again and stop being mad at us? Where was that thinking, Mr. Boystick? On the upside, when the Fed was easing, how come the Fed has to be cautious and gentle and careful when they're tightening the monetary policy, not when they're easing? Just a little something to think about. And when Mr. Boystick says we're going to pause in September, and it appears that this is becoming the consensus for now, are we seeing signs that inflation is cooling down? Because if we have leading indicators that inflation is cooling down and the excess liquidity in the system is also waning down, then sure, we can pause in September, no problem. But here's what we're seeing right now. Excess liquidity is still here, and it's not going to go anywhere, because when you print all of these trillions of dollars, they're not going to disappear in a black hole. They're still floating in the system, producing more and more inflation. And unfortunately, a lot of you, by the way, you buy the propaganda that they've been teaching you in colleges and otherwise, the so-called economists who taught you that inflation is a supply chain problem. You got more demand than supply, and once the supply arrives, problem solved, no more inflation. By the way, they've been saying this for a while now. It's been almost 2 years, over 2 years, and the supply chain hasn't caught up yet with this demand? Maybe because inflation is not really a supply problem. Maybe it is a cocaine problem. When the Fed decided to conduct the cocaine operation of printing trillions and trillions and trillions of dollars to stimulate, quote unquote, the economy, maybe that was the real reason behind inflation. Maybe that is the real cure for this inflation problem. Maybe, as the great Dr. Friedman has taught us, inflation has always been a monetary phenomenon. For example, look at the record reverse repo that we talked about in yesterday's video, $2 trillion in the Fed's reverse repo facility. Now, just a quick brush up, reverse repo means reverse repo. The repo facility, if you're a hedge fund, you get a bunch of bonds, you give that to the Fed as a collateral, they give you a bunch of cash, and you use that cash to manipulate the futures market. You make a quick gain, you give the Fed their cash back, you keep the profits, and you get your bonds back. That's repo. Reverse repo is the opposite. You got the opposite problem. You got too much cash, so you give the Fed your cash, and you capture a better interest rate than any other facility, and you get a bunch of bonds in return. Then you hand the Fed their bonds back, and they hand you your cash back. So when we have record numbers in the reverse repo facility, over $2 trillion, we got an excess liquidity problem, specifically when the Fed is about to tighten. As the U.S. budget deficit shrinks amid robust tax revenues, the Treasury will have to aggressively shrink bill issuance through September 30, analysts said. I wonder why Boystick and the rest want to pause in September. A sharp decline in bill supply will push much of the money fund cash into the Fed's reverse repo facility, draining bank reserves by more than $1 trillion this year, said Joseph Abadi, who's a big shot at Barclays. He expects bill supply to shrink 15% between April 1st and September 30th. It is really a double whammy on the front end because of too much demand and not enough supply, leaving the RRP facility as the option of last resort for many investors, and this is according to TD's Goldberg, whoever that is. The soaring RRP volume does not seem to be a concern for the Fed, given that quantitative tightening will only begin next month, but it could be a problem if demand persists, even after the Fed's asset portfolio starts to shrink, said another big shot at another big shot firm. He also noted that a number of Fed hawks last winter cited the bloated RRP facility as a reason to start cleaning up the Fed's balance sheet through asset runoffs sooner rather than later. Listen to this. Individual FOMC members might start to weigh in on the topic if RRP volumes move north of $2 trillion this summer. We are already north of $2 trillion. Another sign of excess liquidity in the system is the following. Retail inflows at nearly all-time high despite market turbulence. The retail mom and pops have been buying the dip over and over and over and over again, and they've been catching a falling knife over and over and over and over again. Individual investors are buying stocks at a pace akin to the 2021 meme stock frenzy, even as the returns on retail investments still at multi-year lows amid a widespread sell-off on concerns about rising interest rates. And this is according to Vanda Research. Retail investors bought stocks worth $76 billion during the 3-month period ending on May 24th, or $1.3 billion a day on average. Wow. Compared with net purchases of $80.6 billion or $1.32 billion a day in 2021. And these are massive bags, folks. You see, Jerome Powell, vacuum man, he thinks that by using the reverse repo facility and endangering a market accident, he's going to vacuum all of that excess liquidity out of the system. Boom, problem solved. The problem is the reverse repo facility is temporary and it's going to add more liquidity in the system, not less. Meanwhile, the real vacuum machine is actually the stock market. All of these mom and pops and the likes dumping billions of dollars a day, buying the dip, that's the real vacuum machine. Because the stock market, when it crashes and it continues to go down, effectively it sucks away excess liquidity out of the system. It transfers that money from the pockets of bulls to the pockets of bears. Anyways, continuing, that has not deterred small-time investors from buying shares of their favorite tech and growth companies such as Apple, Tesla, and Amazon over the past week. And it's not just the mom and pops who are buying, by the way. Even the insiders are buying. Is this a good sign? Is this a bad sign? Who knows? Because you got Netflix CEO, for example, who bought the dip in January after the first crash of the year in Netflix stock, and guess what? He is now holding a massive, massive bag. But regardless, according to this expert, this strong insider buying suggests a 15% rally in the S&P 500 from here, this point. And look at this. This is the first time in, let's say, a couple of years when we're seeing insiders buying aggressively. So is this a good sign that the insiders are buying, we should buy too? Well, the insiders were right when they bought the dip in 2020 because they got the tip from the Fed that the Fed is about to launch the cocaine operation and rescue the stock market, so that doesn't count. And then they had another tip back in 2018 when the Fed made the U-turn, the flip-flop, and they bought on the dip. But when we zoom back to the history of insider buying, well, it is a mixed bag. It works more than it doesn't, but you have to be a long-term investor, not a trader, not somebody who wants to go to the moon right away. Because as you can see, the insiders bought back in 94, 95, again in 98, but that took years for the investment to flourish. But they were wrong, perhaps the worst call in history, when the insiders bought stocks in March of 2008. That was the worst signal on record because the stock market crashed right away. Is it going to happen again? Well, history says the insiders are right more than they're wrong in the long run. Yet we have examples when the insiders were actually wrong about buying the dip. Yet the bulls would argue that we have more indicators suggesting excessive selling, that the bears are getting too fat. They cannot fight anymore. The bears are going to retreat and open the path for the bulls to initiate a massive rebound rally. For example, when you look at the US ETF monthly flows, these are for individual ETFs. For example, the XLP for consumer defensives, staples, the XLU for utilities, etc., etc. This happens to be the largest monthly outflow in history, suggesting perhaps a selling climax. The bears are getting too fat, and hence the bulls are ready to rally. Another one, we look at the put-to-call ratio in the CBOE equity 10 days average. This is the highest ratio of put-to-calls since the 2020 Thing crash. Now, the bulls would argue that this is a contrarian indicator, pointing out that we have extreme bearishness in the stock market. And soon enough, we're going to see the bulls coming back. Another indicator from the bulls suggesting that the bears are getting too fat is the bets against the RKKKK for Tesla witch Cathie Wood. You see, the bets against RKK peaked earlier this month. Is this an indicator that perhaps the bears are getting too fat and the bulls are safe to run again? Perhaps. Another indicator is the crossing that we got today in the MACD for the S&P 500. The S&P 500 just flashed a buy signal that could mean an oversold rally is on the horizon. And this is according to Katie Stockton, whoever that is. Now, the MACD indicator is not a buy or a sell signal. It is used as a confirmation for either a bullish or bearish momentum, and I'm going to explain in details in the charts analysis. Here's another argument from the bulls camp. $250 billion in rebalancing inflows could rescue stocks by the end of June, and this is according to J.P. Morgan, the Landromat. Rebalancing will probably help bonds more than stocks, but it could push certain stocks, the oversold stocks, higher again. But here's the problem. Now that we have certain technical indicators pointing out for the fact that bears are getting too fat and the bulls about to run again, and oh, by the way, we have indicators that the Fed is waving the white flag and folding already by saying that we're going to pause in September, here comes the out of whack bullish calls, this time around from Evercore, what's his name, Emmanuel, whatever. He now says that the S&P 500 will jump 22% from this point. Okay? What is his argument, by the way? Corporate earnings. How will corporate earnings do when the majority of Americans say they're getting worse financially? We're seeing these signs from Walmart, from Target, from Snapchat. What will support corporate earnings? Anyhow, it's the same guy, by the way, who says crypto crash is not a systemic issue, meaning it's not going to trigger margin calls, etc., etc. And of course, the same guy, when the crypto crash crosses below 20,000, triggering a lot of margin calls, and we see stocks crashing, the same guy will come and CNBC and say, yeah, the crypto crash is causing a lot of margin calls, and therefore stocks are going down, and expect more downside. So screenshot these things so we can say, hey, Emmanuel, this you, bro? Is this the same guy? Crypto crash, not a systemic issue? But anyways, this is the chatter going on in the bull camp, which is a dull, boring camp, by the way. In case you want to hang out with a bunch of dorks, you join the bulls. But in the bear camp, we're happy, we're fat, we're making money, we're playing the stock market rationally, we're playing the upside, we're playing the downside, no problems here, lots of action. It is where the cool kids hang out. So pick your fighter and let me know in the comments, or don't let me know in the comments, because I don't really care. I gotta move on to cover the stock market for you. I'm gonna start with the performance of indices today. And here we go. The Dow Industrial Average closing in the green by 191.66 points, or a gain of 0.60%. The Nasdaq also in the green by 170.29 points, or a gain of 1.5%. Let's just say that. The S&P 500 also in the green by 37.25 points, or a gain of 0.95%. The sector's performances led by number 1, capturing the gold medal, cyclicals. Number 2 for the silver, energy. Number 3 for the bronze, technology. We're not shaming any sector of the market today because all of them managed to close in the green. Here is the advance to decline ratio. NYSE 75% advancing versus 21% declining. The Nasdaq 67% advancing versus 29% declining. Commodities, what's going on here? We're seeing energy commodities moving higher, even though the dollar moved higher again, hurting metals more than energy because the tailwinds for energy are still intact. We're going to talk about that in a second. But the WTI closed the day with gains of almost 1%. Brent closing the day with gains of almost 0.75%. Then we have a rebound in gasoline, gaining almost 1% today. Likewise, heating oil, up big, closing the day with gains of almost 2.5%. And then we have natural gas, which is now trading above $9 per BTU, closing the day with gains of almost 2%. Now look at this. We're exporting more oil and gas. We talked about gas before. The LNG, we're shipping more gas than ever to the European continent. And now we're shipping more oil to the European consumer. You see, this whole war is pretty good for us. We get to cancel Nord Stream 2. No more money for the Russians. All of these billions, they're now in our pockets, baby. We get to sell the oil and gas to the Europeans. We get to sell more weapons and defense equipments to the Europeans. Billions and billions of dollars. War is good. You think this proxy war is about Ukraine? It's not. It's all about the money, baby. And we're about to make a lot of it. And then we have the, if you're betting against oil, by the way, you got the Saudis who are now saying, hey, we've done everything we can. We're not going to do anything at all from this point on, be it pumping more supplies or otherwise, to curb soaring oil prices. In other words, hey, Joe, take a hike, buddy. Stop begging. We're not going to increase oil production at all. Try Canada. And if that doesn't work out, maybe Texas will solve your inflation problem. And then we got natural gas. And again, the expectations are for higher and higher prices. And the reason is the Europeans are now competing on the domestic supply of gas in this country. It's not just the Europeans, by the way, the Asians, everybody else, everybody who's not buying Russian oil and gas. So this summer, expect gas prices to go higher, but have the comfort in your heart when you pay the bill that at least you're sticking it to Putin, bruh. Anyways, moving on to softs, we're seeing gains led by cotton. Cotton closing the day with gains of 2.25%. And then we have coffee closing the day with gains of a little over 1.25%. On the other hand, we're seeing declines for cocoa down almost 2%. Likewise, OJ down a little over 1.75%. And then we have lumber down again by about 1%, and sugar down modestly, but be careful here. We have another tailwind for sugar to move higher because India, one of the top producers of sugar, saying, you know what, we're limiting sugar exports. So India banning wheat exports and now limiting sugar exports. Why? All of these countries are now becoming protectionists. The domestic need first. Indian supplies for Indian citizens. Chinese supplies for Chinese citizens. Australian supplies for Australian citizens, except in the US, of course. US supplies for everybody else, and then comes all of you bum Americans. You come last. Anyways, we're back at metals this time around. Since the dollar is higher, metals are down, gold down, silver down, platinum down, copper down, but palladium managed to close in the green, eking gains of a little over 0.5 percentage point. What about meats? Muted activities for live and feeder cattle futures. And then we have the new big tech lean hogs getting slaughtered again, down about 1%. We don't cover poultry or eggs, but these are moving higher too. Why? Because Singapore, we just talked about protectionism. Here it is. More protectionism. Malaysia is now banning exports of poultry. Are you starting to see a theme here? More countries are becoming more protectionist, or we're going to see a massive famine here. Countries with no supplies, good luck. We also have eggs. Eggs prices could rise as much as 21% this year because we have the bird flu all over the place now. And then you got the thing still. And on top of that, you got monkeypox. So I guess moving to Mars, where the temperature is minus 81 degrees, is not a bad idea after all. Elon is into something here. But here it is, eggs. The USDA is revising their estimates. No surprise here. They say that egg inflation is now going to reach 20%. Let me fix this one for you. Here it is. Yep, much better. How about to the moon? And lastly, what about grains? We're seeing gains for oats, a little over 1%. Then we have muted activities for corn, wheat, rough rice, canola. Yet we have losses led by soybean oil, down a little over 1.5%. Likewise, it was a down day of under 1% for both soybeans and soybean meal futures. Moving on to the big casino, the options market. What's going on here? The volume is still down. It is not encouraging at all, but perhaps it's going to improve in the next few days. Regardless, here's Apple, the hottest table by far, number one, with around 875,000 contracts traded today. About 53% of those were calls. And then we have NVIDIA at around 620,000 contracts traded today. About 55% of those were calls. At number three, Tesla, the Souffle, at around 600,000 contracts, about 48% of those were calls. Moving on to the unusual activities that took place in the options market today. We start with the ticker Vale. For the Brazilian miner, somebody's buying calls here, betting for a move higher in the name. They bought the 19 bucks calls for the expiration date July 15th, with expectations that the name could move higher by more than 8.5% by then. They paid around 60 cents apiece to enter this trade, all in all spending around $1.5 million. And then we have the ticker FDX for FedEx. Somebody's betting on a massive decline here for the name. They're buying the 165 puts for the expiration date August 19th, with expectations that the name could move down by more than 19% by then. They paid around $6 apiece to enter this trade, all in all spending around $12 million. Let's do a deep dive on this one here because they're committing big bucks for this trade, and it could be a bet that oil is going to move higher, and therefore all of these transportation companies are going to get hit hard. When we look at the chart of FedEx, this is a daily chart. When you consider that they're paying $6 a piece for the contracts, the stock has to go down by about 22% for this trade to be profitable at expiration date. It could be profitable before that if the stock goes down rapidly, even though it doesn't have to go down by 22% or more. But if you're going to hold till expiration, the stock has to go down by more than 22% by then. So we got the expiration date August 19th. This is when the trade expires. And then we got a gap at around 140.22. Perhaps the trader is eyeing that gap to be closed. If it does, the trade will be handsomely profitable. Now, if the chart closes above 159 by expiration date August 19th, the trader is going to lose money. If the chart closes below 159 by expiration date, the trader is going to make money. And here's the table for the profits or the losses, depends. And as you can see, the risk versus reward is not worth it at all. Why? Because they're paying a high premium. I'd rather wait for the VIX to collapse to 20 and below and then start buying puts for pennies on the dollar. Because let's say we're now in August 8th, for example, and FedEx is indeed down to, let's say, 180 from 204, which is where it's trading right now. If that happens, the trader is going to lose almost 70% of the value of the trade. And therefore, my hunch is this trader is confident. Perhaps they have insider information or otherwise suggesting that FedEx will crash well before August's expiration date. Anyhow, back to the unusual activities. What about the ticker IWM for the Russell 2000 small caps? They're buying calls here, the 202 calls for the expiration date July 15th, with the expectations that the IWM is going to move higher by more than 13% by then. They paid around 75 cents apiece to enter this trade, all in all spending around $825,000. And then we have the ticker MRVL, Marvell, which used to be long. It was one of the Biden portfolio picks. And then in about November of last year, I announced that I'm becoming bearish on chips and I decided to short Marvell. And somebody here is betting that it is not the time to cover because we have more pain to come for the name. In this case, they're buying the $50 puts for the expiration date, May 27th, meaning this upcoming Friday. And again, if you look at NVIDIA after hours, the assumption is Marvell is going to be down. What happens after that is a different story. If we see a comeback of NVIDIA, for example, the stock is down, 7% after hours? If by tomorrow, NVIDIA closes the day in the green or reduces the losses all the way to 1 to 2%, that would be a bullish signal that the market is indeed bottoming. But in this case, they bought the $50 puts for the expiration date this Friday with expectations that Marvell would go down by more than 7% by then. They paid around $1.55 apiece to enter this trade, all in all spending around $1 million. And then we have GME, GameStop. Here it is. The name was up today, but somebody's fading the rip right away by buying the 100 puts for the expiration date this upcoming Friday, May 27th, with expectations that the name could go down by more than 13% by then. They paid around $1.70 apiece to enter this trade, all in all spending around $1 million. At the bottom of the table, we have the ticker EXPE, Expedia. They're buying calls this time around, the 145 calls for the expiration date, August 19th, with the expectations that Expedia could move higher by more than 17% by then. They paid around $5.75 apiece to enter this trade, all in all spending around $2.8 million. Moving on to the heat map analysis, what's going on here? We're seeing the big pharma names, with exception of AbbVie, losing some momentum. We're seeing some money coming out of the diagnostics, for example, TMO, Thermo Fisher, and then the big pharma, J&J, NVS, MRK, Merck, NVO. We're seeing some profit taking. Where is the money going? The answer is software, chips, technology, cyclicals, hotels, casinos, cruises, Tesla, Amazon, buying the dips in Netflix, Facebook, Meta, even Snapchat caught a bit today. Now, is that going to last or not? That's up for debate, but the bottom line is we're not seeing loss of momentum from the energy trade, for example. We're not seeing a rotation out of Chevron, Exxon, oil and gas, all the way to software or the big caps. We're not seeing that at all. We're seeing some profit taking from the big pharma, healthcare, and the defensives, and some of that money found its way in buying the dip in software, technology, and cyclicals. Now, let's talk about individual names. We start with another update of Sticking It to Putin. Sticking it to Putin, bruh. And this time around, we're going to talk about NVIDIA because, remember, NVIDIA suspended sales into Russia. Here's the result. NVIDIA is down by over 7% after hours, and the reason is they're losing $500 million from the exit of Russia and the lockdowns in China. But hey, on the bright side, at least, NVIDIA is sticking it to Putin by losing $500 million. And then we have calls, KSS. The name moved higher today, massive rebound, and the reason is we're hearing about the takeover talks being revived. survived. Now, let me school you here on one thing. This is not arbitrary, meaning we have a shareholder with a massive stake who's now holding a massive bag after the crash in Walmart and Target, which, as a result, crashed calls. So they grab the phone, they talk to the media propagandists and say, hey, can you pump the story of the takeover of calls, the revival of the takeover talks? And of course, for the right price, the media propagandists will say, okay, no problem. We'll pump whatever you want us to pump. And then you get the news of KSS, the revival of the talks, the stock moves higher, then the whale dumps. And they say, oh, the takeover talks, oh, they've fallen apart. Goodbye. And lastly, in corporate news, we have Saudi Aramco, who's buying the petroleum unit of Valvoline for about $5.4 billion. And as a result, the ticker Triple V surged higher today by double digits. Moving on to the daily heat map for the ETFs. Whether you bet on cyclicals or energy, you scored big because the XRT massive rebound of over 6%, almost 7%. Then you have the XOP in energy closing the day with gains of a little over 4%. So either way, you made big bucks, no problems here. Whether you bet for growth or value, both of them did fine, be it growth, outperforming value, at least for today. But for the rest, muted activities across the board for the banks, for the healthcare, for utilities, consumer staples, international markets, all muted. Nothing is going on here. Commodities, specifically gold and silver, went down slightly, yet we're seeing gains for uranium, solar, tan, and of course the UNG for natural gas. What about the charts analysis? And we start with SPY, the S&P 500 30 minutes chart. The good news is the chart opened higher, then it went down. It retested almost the previous support at 392.39, and then it rebounded higher, and it closed at the highs of the day above 396 and almost at 398, which is now resistance/support. Is this bad for the SPY? Of course not. But is it a solid buying signal? Of course not. But that depends on your risk tolerance. Some folks looking at this chart would say, I've seen enough. I think the SPY is going higher. I'm buying right now. Others want to wait for, let's say, 400, 401, and then they'll be comfortable to buy if these numbers are caught as support. But perhaps the daily chart for the continuous contract for the SPY offers more insight because what we're seeing right now, if we're looking from the bullish lens, for example, we're seeing the chart trading above 3,960, closing above that number. We're seeing 3,855 intact as support, tested many times. On top of that, we're seeing the volume cooling down. And oh, by the way, the momentum indicators are moving their way higher, slowly but surely. We have a crossing in the MACD indicator, pointing out that the bearish momentum is over now, and we're starting a new bullish momentum. That doesn't mean you have to see a rip your face rally. That could mean consolidation. That could mean a mini rebound. But in all likelihood, it means that we have witnessed peak selling for now. Keyword for now. On the other hand, when we put our bear lenses on, the bears would argue it doesn't really matter where the chart is trading right now because so long as the chart is trading below 4,102, nothing is set in stone here. For all you know, Nvidia's earnings, not so hot so, that freaks the market again. We have another flush down. If that continues, if we continue to see these crashes happening, Snapchat, Nvidia, sooner or later, the cracks are going to be too much and the support of 3,855 will be broken. But for now, who has the better argument? I would say 60% the bulls, 40% the bears. Here it is, the SPX, the cash index. It got all the way to 4,000, knocked its head on 4,000 and didn't make it for now. That doesn't mean it is a rejection. It means it's an attempt, and we could have many other attempts the next few days. You continue to knock over and over and over again. Sooner or later, you're going to crack above 4,000. If the bulls manage to close the day above 4,000, the week above 4,000, that would be a major victory for the bulls. On top of that, the volume is cooling down by a little bit, and then we have the MACD indicator showing us for now a confirmation, a green impression on the histogram indicating that the bearish momentum is over for now. It doesn't say it's a buy signal, at least not in my opinion, but it says the bearish momentum has peaked and it's gone now. And there is a new bullish momentum on the horizon. Now it's up to you to make those decisions, whether to buy now, whether to wait for a closing above 4,000. That's entirely up to you. What about the Qs? 30 minutes chart. The Qs moved higher. Now we know that 285 is intact as support, at least for now, and the Qs bumped its head at around 292.22, which is the resistance for now. Did not make it, but it doesn't mean this is a rejection for now. Realistically speaking, if Nvidia is down 7% or so, the Qs is going to open down, gapping down, maybe by a little bit, maybe by a lot, but the point is, are we going to see buy the dip, meaning the Qs open gapping down and we see the dip buyers hopping in right away, we see a reversal, a U-turn, and Nvidia closes the day, let's say with gains or maybe losses of 1 to 2%, mild losses. Now, would that be bullish or bearish? I would argue it's going to be super bullish. But if the chart gaps down and then it continues to melt down, losing the support of 285, then we got a problem. Here's the daily chart for the continuous contract for the Nasdaq, and again, the bulls would argue, forget about the technicals for now. Look at the support of 11,689, for example. Now, for this week so far, we got many bombs. We opened the week on the heels of a weakening consumer from Walmart and Target and the likes. Then came the bomb from Snapchat, confirming that the consumer is getting weaker, confirming that the macro environment is worsening. Tomorrow, we're going to get a bomb from Nvidia, down 7 to 8%. If the chart closes the day maintaining 11,689, forget about the technicals again. From a psychological perspective, you throw all of these bombs on the chart and it continues to hold on. Is this behavior bullish or bearish? I would argue it is bullish. It's not bearish, certainly, when you have bombs like Snapchat and Nvidia and the chart doesn't crash. Another point is the momentum indicators. We have the MACD indicator showing a baby little mini confirmation for now, a little green impression on the histogram that yes, the bearish momentum is peaking for now. Now, bear in mind, anything could happen. We could wake up tomorrow and accidentally China nuked Taiwan, or Russia nuked something, or Joe Biden slipped on a banana peel and died. We see the indices crashing. Anything could happen. But for now, looking at the information that we got for now, I would argue that the bulls are coming back. The bulls are gathering some momentum, perhaps another pop or two, because we've seen rebounds before, but they did not last. They lasted for a day or two, and then poof, they're gone. But what if we have a rally, a rebound that lasts for, let's say, the end of the week? We're going to have a long weekend, by the way. Could that be encouraging for the bulls to finally hop in and buy the dip? Of course. Now, the bears would argue, forget about all of that. We care about the technicals. We'll look at the technicals. What are you seeing right now? You're seeing a bear flag formation. So yes, the bulls are keeping 11,689 for now, but this is a bearish consolidation, meaning the chart is asking, any buyers, any buyers, any buyers. If the buyers don't show up, the sellers will, and the bear flag will play out, and you will see a flush down after losing 11,689. For now, who got the advantage? I would argue the bulls have 60% advantage versus the bears 40%, at least for now. Here's the IWM 30 minutes chart for the Russell 2000. The chart managed to close pretty much at the highs of the day, above 177.85. Do you buy now? Well, you got 181 coming up. Maybe you want to wait for that to happen. Or if we remove all of these lines, what are we seeing here? We're seeing a double bottom. What else? Is this a cup and handle formation? A lot of bulls would look at this information and say, I have seen enough to hop in and buy the IWM, at least via call options for now. What about the Dixie, the dollar index, a daily chart? It is below 103, but again, is this the bottom for now? If it is, that will be bad news for commodities, but specifically metals, because the gold bugs, the silver bugs, they're waiting for the dollar to crash all the way down below 100, 99.9. That would be good enough to initiate a rally in gold and silver. And here is gold, the daily chart. Again, we have a pullback, perhaps a retest at around 1,850, the Fibonacci retracement support. But if that is broken again, that would be a bearish signal indicating that gold has lower lows to visit. What about Brent oil? This is a 4 hours chart. Again, it is battling 114, 115 in a bullish pattern. So do you buy now? I would wait till 115. I'd like to be conservative here. Wait till 115 is broken as resistance, and then we're going to see a rally all the way to 118, if not beyond, to 120. If that happens, a lot of oil shorts are going to panic, initiating a short rally that could take us back to 140. Here's the daily chart for the 10-year yield. We got the head and shoulder formation, the bear flag formation. Doesn't matter to me, but it is playing out. Now we got support at around 2.72. If that is held and we see a rebound, then watch out. The TLT is going to flush down again. We could see any momentum fading away in the equities market if we have a big rebound. But if 2.7 is broken as support, then we have 2.5% coming, and that would be good at least for the NASDAQ. We're not looking for the 10-year yield to flush down in a crash. We are simply looking for the 10-year yield to consolidate and cool down. Here's the TLT moving higher. The bull flag is playing out. We're not seeing any resistance or reversal for now. So far, so good for the TLT. Here's the 4 hours chart for the VIX. It remains inconclusive because look at the MACD indicator. Yes, we're seeing red impressions in the histogram from a 4 hours perspective, but it is not a solid confirmation. We have seen false signals before, so we're waiting for a clear signal. Big, beautiful red impressions in the histogram, which will come hand in hand with a flush down in the chart. Then we'll know 24.29 is the next support. If that doesn't hold out, then we have 20 as the last support. And if the VIX goes below 20, then you know this is the time to buy puts, to start loading up on puts because they're going to be cheap, but they're not going to be cheap for too long. But we're not there yet, so we'll take it one day at a time. Here's the VXN, again, inconclusive, and the reason is, yes, we have bearish momentum on the MACD indicator, but the trend line remains intact, and therefore, do you have a solid signal to buy the dip in the Qs? Of course not. We got to see the VXN flushing down, losing support. We have to see the Qs rebounding from the NVIDIA sell-off. We need to see the Qs capturing more support lines, then we're going to be more comfortable in calling a rebound rally. What about Apple? What's going on here from a daily chart perspective? We have 138.79 still intact as support. We're seeing the momentum indicators cooling down. The MACD did not cross yet, but it's about to. And if Apple rebounds, so will the NASDAQ. What about tulips? BTC consolidation still going on, asking for buyers in a bear flag pattern. No update here whatsoever. But Bitcoin is an important indicator for those who want to buy the dip in the equities market, because if we get a rebound, a big one, and we see buyers showing up in cryptos, in this case Bitcoin, that will be an indicator for risk on. If we got risk on in cryptos, we have risk on in the NASDAQ, the SPY, and the rest. And lastly, what about the Souffle Tesla? From a 30 minutes perspective, we got a sloping, descending line of resistance. For now, is it going to be broken? Perhaps, but we have to see higher lows. So far, the chart is making lower lows. It is kind of cooling down for now, maybe bottoming for now, but it needs to make higher lows. Now, crossing above the sloping, descending line of resistance is a good sign, but the confirmation would be closing above 700 once again. And here is some Souffle news for you regarding Reverend Elon Musk. Of course, we know by now the pitchforks and the long knives are coming for Reverend Elon. For example, all of a sudden the sexual harassment suit, that can proceed in court, right? Before it was not proceeding, now it can proceed in court, no problems at all. And I wonder why. But anyways, the pain in Tesla is extreme for now. We are witnessing a historic crash, the likes that we have never seen before. Tesla stock lost $575 billion from the top, the biggest loss in history. And then we have Reverend Elon losing almost $60 billion. On top of that, Reverend Elon is now down on his Twitter investment, but after hours, Twitter popped 7%, so we're back in business. And of course, with the crash in Tesla stock, in all likelihood, Elon is going to scrap the deal because paying $44 billion for the trash company, Twitter, is not worth it at all. Nobody's going to fund such a stupid deal. The company's worth probably, at best, $20 billion. So now Elon is saying, it's the bots. They lied about the bots, and this is the reason why I'm going to back out. The SEC is not going to buy that at all. But Elon is now busy with other things, such as preserving civilization and the human population. For now, he says Italy will have no people at all if the birth rate continues. So if you're Italian, according to Elon, lose the condoms. You don't need that. Just go all in. And then you have a bunch of babies, and that would be the ultimate margin calls, and you'll get gray hair and a belly, and you'll live happily ever after. And of course, we're getting the news day by day now from the Johnny Depp trial that Reverend Elon, allegedly the smartest man on the planet, got juiced like a donkey, got played like a fiddle by Amber Heard, who made him donate millions of dollars on her name. The rumor has it, he didn't even get laid. Anyhow, we're moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We got initial jobless claims. On top of that, we got pending home sales. What do we have on the earnings calendar? We got Macy's, Costco, and Dollar General, or Dollar Tree, excuse me. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
I have a car and a house and a family, and it's all paid for.